This video will focus on the residual income model for estimating the intrinsic value of the common stock of a firm. Residual income models of the equity value have become widely recognized tools in both investment practice and research. Conceptually, residual income for a given time period is the earnings for that period in excess of the investor's required return on the beginning of the period investment. The required rate of return can be thought similar to the investor's opportunity cost for investing in the stock. That is, this is the return that the investors forego when investing in the stock. Suppose the shareholder's initial investment is $200 million and the required rate of return on the stock is 8%. Assume the company earns $18 million in the course of the year. How much value has the company added for the shareholders? The required return is calculated as the required rate of return of 8% times the initial investment of $200 million or $16 million, which is the amount investors could have earned in an equivalent risk investment. Only the residual or excess amount of $18 million, which is the net income, minus $16 million, which is residual income, or $2 million represent the value added or an economic gain to shareholders. So, $2 million is the company's residual income for the period. The appeal of residual income models stem from a shortcoming of traditional accounting. Specifically, although a company's income statement includes a charge for the cost of debt capital in the form of interest expense, it does not include a charge for the cost of equity capital. A company can have a positive net income but may still not be adding value for the shareholders if it does not earn more than its cost of equity capital. Residual income models explicitly recognize cost of all the capital used in generating income. Let's look at another example. AXCI, a very small company in terms of market capitalization, has total asset of $2 million financed 50% with debt and 50% with equity capital. The cost of debt is 7% before taxes. This example assumes that interest is tax deductible, so after-tax cost of debt is 4.9%, which is calculated as before-tax cost of debt of 7% times 1 minus the tax rate of 30%. The cost of equity capital is 12%. The company has earnings before interest and taxes, or EBIT, of $200,000 and a tax rate of 30%. Net income for AXCI can be determined as follows. EBIT, which is given in the question, of $200,000 less interest expense of $70,000 gives us the pre-tax income of $130,000. Now subtracting the income tax expenses from this pre-tax income gives us the net income of $91,000. With earnings of $91,000, AXCI is clearly profitable in an accounting sense. But was the company's profitability adequate return for its owners? Unfortunately, it wasn't. To incorporate the cost of equity capital, let's compute the residual income first. One approach to calculating residual income is to deduct the required income from net income. So basically, the required income for AXCI is 12%, which is the cost of equity capital, times the beginning book value of equity, which is $1 million, which is equal to $120,000. Residual income is calculated as the net income of $91,000 minus the equity charge, or the required income of $120,000, which is equal to negative $29,000. Hence, AXCI did not earn enough to cover the cost of equity capital. As a result, it has a negative residual income. Although AXCI is profitable in accounting sense, it is not profitable in the economic sense. A company that is generating more income than its cost of obtaining capital, that is, one with the positive residual income, is creating value. Conversely, a company that is not generating enough income to cover its cost of capital, that is, a company with negative residual income, is destroying value. Thus, all else equal, higher residual income should be associated with higher valuations. To illustrate the effect of residual income on equity valuation, let's continue with our example of AXCI presented in the previous example. Let's assume the following. Initially, AXCI equity is selling for the book value of $1 million with 100,000 shares outstanding. Thus, AXCI's book value per share and the initial share price are both $10. Earnings per share, or EPS, is given by the net income of $91,000 divided by number of shares outstanding of $100,000, or 91 cents. Let's assume the earnings will continue at the current level forever. And let's also assume that all of the net income is distributed as dividends. Because AXCI is not earning its cost of equity capital as shown in the previous example, the company's share price should fall. As calculated in the previous example, AXCI is destroying $29,000 worth of value per year, which is equal to 29 cents per share, which is calculated as $29,000 divided by 100,000 shares outstanding. Discounted at 12% cost of equity, the present value of perpetuity is $2.42, which is calculated as the residual income of negative 29 cents divided by the cost of equity capital of 12%. The current share price minus the present value of value being destroyed is $7.58, which is calculated as $10, which is the current market price, minus the present value of the value being destroyed is $2.42. So the price of the stock should fall from $10 to $7.58. The residual income model of valuation analyzes the intrinsic value of equity as the sum of two components, the current book value of equity and the present value of expected future residual income. According to the residual income model, the intrinsic value of common stock can be expressed as follows, where V0 is the value of the share of the stock today, B0 is the current book value of equity, BT is expected book value of equity at any time in future, R is the required rate of return on equity investment, ET is the expected net income for period T, RI is the expected residual income, which is calculated as ET, which is net income for the period T, minus R, which is the required rate of return on equity investment, times the book value at the start of the period T. Let's look at an example. XYZ Tool Company manufactures machine tools for other manufacturing firms. The firm's accountant developed the following long-term forecast for comprehensive income. The accountant expects the comprehensive income to grow 5% annually after year plus 5. XYZ pays 30% of comprehensive income each year as dividend. Total common shareholders' equity on January 1 of year plus 1 is $1,111,141. XYZ has a beta of 2, assume the risk-free rate is 2% and the market return is 7%. Using the residual income model, compute the value of XYZ Tool Company as of January 1 year plus 1. The first step is to calculate the cost of equity capital using the CAPM model. Cost of equity capital is the risk-free rate of 2% plus the beta of 2 times market risk premium, which is the market return of 7% minus the risk-free rate of 2%. Plugging in the numbers in the CAPM model gives us the cost of equity capital of 12%. The next step is to calculate the common shareholder equity at the start of each year. We use the following formula to do that. Total common shareholders' equity at the start of year plus 1 is $1,111,141, and the forecasted income for that year is $213,948. Question also tells us that the firm pays 30% of net income as dividends, which for year plus 1 comes out to be $64,184. Plugging these numbers in the above equation gives us the total common equity at the end of year plus 1, which is also the same as the total common shareholders' equity at the start of year plus 2. Following the similar process, we can calculate the total common shareholders' equity at the start of each of the next 6 years. Once we have all of the above information, it is pretty simple to calculate the residual income. For the year plus 1, the forecasted comprehensive income provided in the question is $213,948. Required income is calculated as the cost of equity times the book value of equity at the start of the year plus 1, or 12% times $1,111,141, which gives us the required income of $133,337. Next, the residual income is calculated as the comprehensive income of $213,948 minus the required income of $133,337, or $80,611. The next step is to find the present value of the residual income using 12% as the discount rate. You can also use your financial calculator to calculate the present value using the following inputs. n equals to 1, interest rate is 12%, future value is 80,611, payment is 0, compute present value. You should get the same answer. Following the similar process, we can calculate the present value of residual income for the next 5 years. The next step is to calculate the continuing value of the firm. Following the above procedure, we calculate the residual income for year plus 6, which is negative $44. Then using perpetuity with growth model, we find the value of the firm at the start of year plus 6. We divide the residual income of negative $44 by the difference between cost of equity capital of 12% and the long-term growth rate of 5%, which is provided in the question. This gives us negative $609. Discounting it back 5 periods gives us the present value of negative $357. Adding all of the present values with the common shareholder equity at the start of year plus 1 gives us the total value of the firm. Note that while discounting, we assumed all of the net income is generated at the end of the year. However, in reality, the net income is generated throughout the year. To deal with this issue, we perform a mid-year adjustment by multiplying our estimated total value by 1 plus cost of equity of 12% divided by 2. This gives us an overall value of the firm as $1,316,343. If the question provided us with the number of shares outstanding, we can use that information to calculate the per share value. A common mistake in the application of residual income model is that one assumes positive residual income will persist forever. More likely, a company's net income will revert to the mean value of required income over time, and at some point, the company's residual income will be 0. If a company or industry has an abnormally high net income, other companies will enter the marketplace, thus increasing competition and lowering the returns for all companies. Similarly, if an industry has a low net income, companies will exit the industry through bankruptcy or otherwise, and returns will tend to rise over time. The residual income model is a useful addition to an analyst toolbox. Because the record of residual income can always be calculated, a residual income model can be used for both dividend-paying and non-dividend-paying stocks.